Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como. I'm with Ireland Como Lafoy, and today is the 16th of July. At least I think it's the 16th of July. 16th of July. All right, let's get into what is happening in the markets today. We have canola down $6.60 at 6.76 even. Minneapolis wheat was down 12 and a half cents at, or sorry, 1.25 cents at 6.20. Kansas wheat was down a cent at 5.22 and 3/4. Chicago wheat was up 3.25 at 5.41 1/4. Soybeans were up 18 and 3/4 cents today on the November to close at 10.20 and a half. We'll have a little bit of news on soybeans here in a second. Soybean oil was up 28 points at 54.68 a pound. Corn was up 4 cents at 405 1/4. Canadian dollar still below 73 cents, but just barely 72.99 at the time of this recording. Live cattle and feeder cattle both jumped up a little bit today. 147 100 on the live cattle, 220 and 3/4 or 220.75 is the live cattle futures. We have moved to the October, I think, as we stated yesterday on our futures reporting here. And feeder cattle at 325.57. That is up 330. We have a little bit of news on cattle here as well today. All right, we're going to start off with canola today. This is an exclusive article from Reuters. We did talk about this in our morning commentary today, which if you don't get our morning commentary, make sure that you subscribe to our premium content as we send a morning recap every morning. So Australia is near a breakthrough canola deal with China. At least that's what sources say. This would allow Australian suppliers to ship, I think it's 5 trial canola cargoes to China after there's been a multi-year freeze in trade between the two countries. China, of course, is the world's largest canola importer. It sources nearly all of it from Canadians, from Canada, but those supplies could be limited by, there's an anti-dumping probe going on between from Beijing to Canada as well. China has also imposed 100% tariffs on Canadian canola meal and oil this year, which is affecting the flow of some of those processed products. Again, this is amid strained diplomatic ties, so China may be looking to diversify their canola sources a little bit to some degree. Again, this could be it could be a problem for Canada, but it also could be neutral. Obviously, Australia is a big exporter of canola. They export almost 80% of their canola, meaning they already have customers for this 80%. Production in this next year is about to be the same as the last 2 years. So it's not like they need to ramp up their export program significantly. And that means that some of the markets that were being serviced by Australia in the past couple of years, if China becomes a bigger buyer of Australian canola, then those countries will have to source their canola from somewhere. So the S&D globally may, continue to balance, but Canada may lose some of that business to China from Australia, or lose it to Australia, I suppose is the right way to say. Here's what canola futures did today. It did drop, and I wouldn't say it didn't go to new lows, but this is the lowest close that we've seen since the beginning of June. The previous the previous close was somewhere around 672 or something like that. I think 665 is where. Let me get my trusty laser pointer here. 665 is where this particular support exists. I could still see it moving down to that level at this point in time. And as you can see, the 100-day moving average is also creeping up to the area. So there's kind of a double support that could be there, which could magnetically pull canola futures down to that level. Then we'd have to see if it continues to lag below that. That could signal some further weakness as well. If you are still looking to hedge some canola and take some risk off the books, if you haven't done any yet, there still is a carry in this marketplace. It's not full carry by any stretch of the imagination, which has its benefits in that full carry generally means a very bearish market. We're about midway through full carry. There is still a pretty healthy carry in this marketplace. As you can see, there's a $8.10 carry between Nav and Jan, and then a 620 from Jan to Mar, and a 520 to May, and another 380 to July. So what that kind of looks like is Going to January, you get an extra $8.10. This is just the futures, by the way. There may also be some basis incentives to do that, particularly as you move into the spring. And of course, you can also execute strategies where you don't put on your basis at all and you're just hedging futures. But anyway, I digress. There's 1570 now from November to the March. There's $20.90 for, all the way to the May, and then almost $25 to the July. So capture and carry in this market still isn't a bad strategy, particularly if you don't need the cash flow or you don't need the bin space in the November period. That may be of benefit to you if you're still looking at layering off some of that canola risk. Soybeans today had a really good day, up 18 cents or 1.8%. President Trump, U.S. President Trump announced a preliminary trade deal with Indonesia on Tuesday, and this reportedly included commitments to purchase $4.5 billion in ag products. Indonesia is actually a significant importer of U.S. soybeans, particularly for food production. While China is the largest global importer of soybeans and they largely use it for animal feed, Indonesia is a major buyer of U.S. soybeans within Southeast Asia, with actually a strong preference for U.S. soybeans in its traditional, like food products, tempeh and tofu, which are very similar products but just processed differently. So that could be. I think that's probably the reason why we saw such a big leap in soybeans proper today, because as you can see, we have been seeing some strength in December soybean oil or in soybean oil. Last 4 days, we've seen gains in soybean oil, but nothing that would suggest that the soybean run today was a result of biofuel policy or anything like that, which a lot of the volatility in soybeans recently has either been fundamentals on the US side in production, or biofuel policy on the oil side, which has supported prices. Today, it's likely trade or non oil demand trade and exports from the U.S. Euronext rapeseed gave back a lot of its gains from yesterday today, so it's kind of we're kind of at even or still a little bit higher, I suppose, than we were at the beginning of the week. We are going to put together a fundamental picture of European rapeseed as well as wheat in our weekly report that we're going to send out later or at the end of this week, which does remind me, if you are not a subscriber to our premium content, only our subscribers to our premium content get those weekly reports and our ad hoc reports and our morning commentaries and anything else that we put out. So we suggest that you do subscribe. This is what the covers of our reports look like, and they contain a lot of really great information. We usually break down some kind of fundamental, maybe some technical, maybe some education and things like that in these reports. So they are, our consulting clients find them very valuable, and you might too. $99 a month. You can cancel anytime. Hit that subscribe button at canadianagmarkets.com/subscribe. We'll also put that link in the description below if you want to take a look there. But yeah, we appreciate your business. All right, moving on to some of the grains and other markets today. Chicago corn futures did rise for the third day in a row today. Extended recovery from contract lows with, even with favorable U.S. crop condition ratings. Now, a couple days we did kind of talk about this engulfing pattern that we saw on Monday, on Monday's trade, where it hammered to a new low, but the candle basically completely engulfed the previous day's trading range. That was a bit of a bullish reversal signal. I know other commentators, one that I follow very closely is Joe Vaclavic, also talked about that in his commentary the same day. So not only me thinking this, and obviously the market is also covering some of this short risk as well. We are coming up to the 20-day moving average. In fact, it did test that today almost exactly on the nose. So we'll have to see if that acts as some resistance and the rally is over after this. If that is the case, we'll push back lower. But if we do break above this 20-day moving average, I would say that there's momentum to carry the corn market forward and maybe even to some of these previous highs in that 445 area. As long as it can clear, some of these other moving averages. But that's where I would say there's some consolidation of trade up here in that 440, 435 to 445 area. So I could conceivably see it getting there at some point. Chicago wheat today, the wheat market did find some support. Today, again, there's some delays in harvesting and export loadings in Russia, though analysts expect supplies to build, in the rest of July as harvest in Russia accelerates. There was news that major importer Algeria had, booked around 1 million tons of wheat in a tender on Tuesday, and there was some news out of Russia as well. Saw Vicon up their assessment, I think, on Russian wheat from 84 even to 84.6 or something like that. So there's some news in the wheat market that was creating some push and pull in the wheat markets. As you can see, September Chicago wheat isn't really doing anything special crazy today. It did actually break to it did break that June 30th low for a brief period today, but rallied back. So I don't know. I still think that this market does still look relatively weak. We could still come back and see a test of that 522 or 525 area, but a little bit of positive news with that Algerian tender today. Here's December Minneapolis wheat. It continues to lose value. Again, we're looking for a test kind of back down to that 605. At least that's our kind of not worst case scenario, obviously, but conceivably, it looks like we could go back to test those lows, particularly as this is a seasonal time that we might want to, that wheat can do that. Kansas wheat, very static, very stagnant. It's almost through its harvest, particularly in those southern states like Kansas, Oklahoma, Texas. Nebraska still has a way to go. Colorado still has a way to go. Those are both HRW producing states. But the HRW harvest is largely complete now. So not a lot of bullish information to trade off of that at this time. Saw a really good article today in Successful Farming. I'll put the link to that as well below if you want to check that out. Talking about defending or protecting against as a result of this rebound in cattle prices. Cattle, we are seeing new highs today. So this market continues to move higher. We did see a peak on June the 9th, and now it's kind of moving, and then a preceding move lower, and it's rallied back to make new highs now. It's just trading, right about 221 per hundredweight as, today. I think, what I read in the articles that there was better demand into the 4th of July. This is considered, grilling season. We often see prices rise during grilling season. Feeder cattle didn't necessarily make a new high, but it's back kind of at those old highs. The risk really here is those finishing cattle. Historically, demand does wane in the midsummer. As I said, the grilling season is considered mostly behind the market. For now, the long-term uptrend in cattle prices remains intact. However, there are concerns that, the consumer dollars are being stretched and might also suggest another reason for the market to be vulnerable of a price break. I think what's going to happen with this cattle market is that we've seen this dramatic rise, new highs, lots of, fever and froth around this marketplace. Those are the markets that tend to correct really fast and really hard. All right, that is all we have for you today. Thank you for joining us. We will see you again tomorrow.